Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now today I want to talk about the euro. This is one major currency that has consistently weakened against most other major peers since early February as geopolitical tensions around Ukraine escalated. Now the euro is an interesting currency today from a variety of perspectives. The share of the euro in international payments, for example, is now as high as 37.5% in 2020, not that far off from the 42.6% of the US dollar. If you're an architecture buff, you would have also noticed that the physical euro banknotes each contains images of different architectural styles from European history. So classical on the €5 note, Gothic on the €50 note, and Renaissance on the €100 note, just as examples. So have a look if you have a euro banknote tucked away somewhere. Now, as investors, we often look at the euro as a default anti-US dollar currency, given it forms overwhelmingly the largest weight in the global US dollar index, or the DXY. Relative bond yields are one driver of currency pairs, and this has meant the euro has been on a weakening trend against the US dollar for well over a year as expectations of Fed policy rates climbed, while the ECB was at pains to keep euro rate expectations capped. ECB policymakers, of course, have been tilting more so towards supporting the growth recovery and been less concerned about inflation, at least relative to policymakers over at the US Fed. So in contrast, this has meant that market expectations of ECB rate hikes have been capped at about one rate hike in 2022, contrasting with peaks closer to 6 to 7 rate hikes by the Fed. Now, looking a little bit shorter term, the euro has been amongst the major currencies most affected by the ongoing conflict in Ukraine and its potential fallout. It weakens if capital flows to the US dollar as a safe haven increase, as we've seen the last couple of days, and its economy arguably has relatively closer links to Russia, two examples being its dependence on Russian oil and gas imports and some sector exposure through the banking sector. Now, where all this leaves us is that we see an opportunity in being bearish on the euro JPY currency pair as a hedge against the possibility of further escalation in geopolitics-driven risk aversion. We've spoken before about the Japanese yen and how it has room to rise sharply in the event of a surge in safe haven demand, in our view. We believe matching it versus the euro is attractive because the euro is likely to weaken in such a scenario, helping push the euro-yen pair lower. From a technical perspective, euro JPY has held below resistance at 133 to 134, and we believe a break below support at 127.35 and then 126.5 can trigger a decline towards 124. We've had a bearish trade open on this pair since 21st February, so please do take a look at our daily FX Navigator publication if you want to take a look at specific levels. Now, before I end this podcast, I just want to point out that this week, Fed Chair Powell is scheduled to deliver a semi-annual monetary policy update to the House and Senate committees on the 2nd and 3rd of March. These assume particular importance, of course, as markets will watch how he's balancing existing pressures to raise Fed rates against the risks created by the conflict in Ukraine. It's key for financial markets broadly, of course, but also quite important for the euro-dollar pair via its impact on the US dollar. So something to keep an eye out for, but one idea is a potential risk hedge. But I'll take a pause there. As usual, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening. We wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.